What's up, YouTube? I'm Adam O'Dell, Chief Investment Strategist at moneyandmarkets.com. I'm joined this week by my research analyst, Matt Clark, and we're here for another episode of Ask Adam Anything, where you can literally ask me anything about individual stocks or ETFs or the broader market or investing strategies in general. So please leave your questions or comments down below in the comments section, or you can email us at this email address right here, and we will be glad to get to the questions that we feel are most pertinent. I try to answer every single question that comes in, and we highlight some of the best ones this week. So Matt, I'll let you take it away with this week's question. It's, I believe, on a market move that is rather atypical that happened this past week that we want to dig into some.
Yeah, absolutely. And first off, thanks for taking the time. Definitely appreciate it. But yeah, I'll jump right into it. And I will preface everything by saying, just real quickly, we'll cover it a little bit later in the video. But what we're going to be talking about today is something that Adam and myself and Charles Sizemore, Greens and Fortunes Twitter, we're very intimate with, especially this week. And I'll lead more into that a little bit later. But first, one big market move that I don't remember if they actually shut down trading of this over a day, but it made big headlines at the beginning of the week, and that was trading the VXX. That's the ticker symbol VXX. And so first, before we get into the rumblings and everything that happened with it, I wanted to kind of give a bit of a primer in terms of what is the VXX and how it correlates with other things, because it's kind of complicated when you really think about it. It's not as simple or as straightforward as it might sound. So I'll start with that. Let's talk about VXX.
Yeah, so VXX is the ticker symbol. If you go to your brokerage platform and type in VXX instead of a stock symbol, you will get an exchange traded product. Now, most of the time when you talk about exchange traded products, you're talking about exchange traded funds or ETFs. But there are also exchange traded products called ETNs, or exchange traded notes. We could get into the difference between those in a minute if you'd like. But nonetheless, this is a product that you can buy that, generally speaking, if volatility is rising in the market, or if folks are worried about stock prices going lower, typically you'll see shares of VXX go higher. So people like to buy it kind of as a crisis play, buying VXX if they think that stock prices are going to fall and there's going to be some type of panic. Otherwise, most of the time, shares of VXX fall lower. But that's just what it is as far as mechanically speaking. I don't know if you want to get into the details of what it tracks and what it's supposed to represent.
I think we can cover it kind of in a broad sense. Sure, I think that would be valuable.
Okay. So there's layers of derivatives to this. It's quite interesting, actually. So the S&P 500 is a stock market index. It contains 500 actual stocks of large cap stocks, US stocks, so S&P 500. Now, you can also trade options on the S&P 500, okay? So if you're worried about the S&P 500 falling in price, you can buy put options. If you want a leveraged bet on the S&P 500 going higher, you can buy call options. Now, when traders buy those puts and calls on the S&P 500, they pay a market price. And that based on the market price they pay, you can determine mathematically how much volatility they expect over the next 30 days, okay? So generally speaking, if traders who are buying options on the S&P 500 are willing to pay higher options premiums, then that is indicative, or it signals that they are expecting higher levels of volatility. Likewise, if they're only willing to pay low prices or low premiums for those call and put options, then it implies that they're not expecting many wild moves. They're not expecting much volatility in the market, okay? So based on the trading prices of options on the S&P 500, you get an index called the VIX, or the Volatility Index. It's managed by the CBOE, the Chicago Board of Options Exchange. And the VIX is often called the fear gauge, because basically when the VIX moves higher, it implies that everybody is worried about stock prices falling and they're willing to pay higher prices for put options. They're willing to pay for more expensive insurance against the market crash. And then when the VIX is low, it basically means that everybody is feeling hunky-dory, that stock prices are going to continue to kind of edge higher. They're not worried about a crash or a pullback, and the VIX is low. So that's why the VIX is called the fear index. Nonetheless, the VIX is not tradable. The VIX is just an index. It's a mathematical calculation, so you cannot trade the VIX. So here's the next interesting step. In the futures markets, there are futures contracts that are meant to track the VIX, and you can buy them either front month that expire in a month or so, or many months down the road, okay? So those trade in the futures markets. Now, VXX is an exchange traded product managed by Barclays, a British bank. And VXX basically buys futures contracts on the VIX. They buy two different contracts. One expires very soon. The next one expires a little bit later. But basically, the profits and loss that are earned on those futures contracts dictate the profit or loss that is earned on VXX. So I kind of lost count, Matt. I hope our viewers are still with us, but to me, that seems like either between 4 and 6 different layers of derivatives, going from the S&P 500 stocks to options on the S&P 500, to the VIX index, to futures on the VIX index, to an ETN that trades futures on the VIX index, and that is VXX. So I'm sure we may have lost everybody at this point, but VXX made a really interesting move on Tuesday this past week. It shot up nearly 50% at one point, and that's probably what we really want to get to.
It is. But first off, I want to kind of circle back because you mentioned that there are, a lot of people may not know this, that there are different exchange traded products out there. Most common are ETFs, or exchange traded funds. These are the ones where you hear of a lot that have a basket of stocks. They benchmark against a particular index of some kind. It could be the S&P 500. It could be something as very specific as to whatever sector the ETF is working with. And then you have exchange traded notes. Now, there is a significant difference, and VXX is known as an exchange traded note. So briefly, what is the difference between an ETF and an ETN?
You're right. So first of all, I want to just kind of give the caveat that an ETN is generally viewed as a little bit more risky than an ETF, mainly in the sense that they have counterparty risk. Okay. In this situation, Barclays is the bank, the issuer of this ETN. And if Barclays as a bank goes belly up tomorrow and has no funds whatsoever, then you might get caught holding the bag, because ultimately that's the counterparty which you want to be healthy, and that would make this note right. An ETF is basically an exchange traded fund. An ETF simply goes out and buys all the stocks in the S&P 500. So they own in that account all the actual shares of the stocks upon which they track. So there's really not as much counterparty risk there, unless all the stocks in the S&P 500 go to zero. You're really not going to see an ETF go to zero, and you actually have assets there on the books that aren't derivatives. Okay. Where an ETN is different is an ETN is just a debt obligation. Basically, Barclays is saying that, hey, anybody that buys this exchange traded note, we're going to give you the profit and loss of a series of returns on an index. Okay. And we just have to have good, we have to have faith in the bank that they have the money and that they hedge their product and they hedge their exposure correctly, so that ultimately, if you as the buyer of this ETN makes a profit, that Barclays is going to pay you out on that. Okay, so there is counterparty risk there. So that's the big difference between an ETF and an ETN.
Now, you mentioned on Tuesday there was the VXX was a huge market mover. I mean, this thing jumped, it went crazy. It was kind of one of those things where very unexpected, especially for this particular type of an exchange traded product tracking these particular derivatives that we've already talked about. So I guess explain in layman's terms what happened on Tuesday, what caused the price fluctuation.
I'll get there, Matt, but there's one more step. For everybody that's still with us, there's one more step. I need to explain how ETFs and ETPs, ETNs trade through banks and authorized participants. And basically, there's this process called the creation redemption process. Okay. And this is different from how individual stocks trade. If you look at Apple, they have a certain number of shares outstanding, okay, that are floating in the market. And when you buy and sell those shares, it doesn't change from one day to the next. Well, ETFs and ETNs are different. They are meant to track an index. And so to make sure that the actual market prices of those ETFs and ETNs are as close to the index as possible, the big banks, they're called authorized participants, but they're generally big banks that trade and kind of market make your orders when you go to buy and sell these. If basically a lot of people on a given day want to buy a particular ETF, then they create shares. And if conversely, if a bunch of people want to sell an ETF on a particular day, they can redeem those shares and basically take the supply out of the market. And the only thing you need to know really is that the function of that is that it keeps the market price very close to the index price. And a big upswell of demand for those shares or a big supply, a lot of selling orders, won't really move those prices unless the index moves. So that's the way that the, for regulatory reasons and for mechanical reasons, that's the way that the creation and redemption process starts or is supposed to work on a day-to-day basis. Now, what happened on Tuesday of last week? It was actually announced on Monday of last week. Barclays announced that they would no longer create new shares of VXX. So if you wanted to go buy shares of VXX, you could buy them on your trading platform on Thinkorswim or Schwab or whoever you trade through, but you would not be there would not be an increasing number of shares. And basically what that meant was that the market price of VXX was then at the mercy of how much demand there was for the shares. So if there was a large upswell in demand, it was a lot easier for the price of VXX to shoot higher because there weren't new shares being created to kind of match out that demand. And that's exactly what happened on Tuesday. So actually, I saw this announcement on Monday. One of my trading services called 10x Profits, we were already in a long position on VXX. We were in that position from January 27th, I believe, because my market timing model basically told me that the spread between the markets, globally and U.S. sectors was too large and was indicative of a period of rising volatility. So we were already accruing profits on that VXX trade well before Monday of last week. But nonetheless, as we got that run up, shares of VXX traded about 50% higher on Tuesday, and we took profits on a portion of our position for upwards of 50%, I believe. The other thing I did is I run another options trading service, and on Monday, when I saw that this was no longer going to be tied to its indicative value or its index value, I recommended some out-of-the-money call options on VXX, and we were able to sell those less than 24 hours later for a partial profit on part of our position for 50% as well. And that's really basically because this was probably a one-time event. I don't know if we're going to get a spike like that again. It's possible. What I do want to share with everybody that's doing this is that if you look up VXX and if you are unfamiliar with the product, this is now a more uncertain product. A lot of folks are speculating that Barclays made this move because maybe they were overextended with the thing that's going on with nickel and the London Metal Exchange. Maybe they didn't have enough collateral. Maybe they had margin calls. So something may be going on there, and this may be an intermediate step toward them ultimately closing down the product. This is a big product. There's almost $1 billion worth of assets in this product, and it's used by institutional and retail traders alike. So I would really be sad to see this product go away. I think it serves a role in the market, but people do need to be there's a buyer's beware aspect of this now, both in the fact that it's an ETN and there's counterparty risk with Barclays, and by the fact that they can kind of close it down at their own discretion anytime they'd like.
So very interesting take. A lot of information to soak up there, but I think it's really important, especially when we see big market moves like this, to really kind of boil it down and explain exactly what it is, and then get even a little more granular and talk about the actual product itself, which I think you did a great job with explaining what VXX is, how it correlates with the VIX, and then kind of what happened, the difference between an ETF and an ETN, and then kind of boiling down what happened on Tuesday last week that caused this shift in price. Things have kind of leveled out in terms of VXX at this point. It's obviously pared back a little bit, so not nearly as big as it was last week. So Adam, again, thanks for your time. Definitely appreciate it. Look forward to doing this again next week.
Sounds great. Thanks a lot, Matt.